Momentum is not a single monolithic strategy. In the world of quantitative finance, time series momentum, TSMOM, and cross-sectional momentum, XSMOM, represent two fundamentally different approaches to capturing the same underlying behavioral bias, the tendency of investors to underreact to information, leading to trends. At the heart of the difference between time series and cross-sectional momentum lies the construction of the signal. Time series momentum asks a single, absolute question for each asset: did it go up or down over the past J months? If the cumulative return is positive, the strategy goes long; if negative, it goes short. This signal is based solely on the asset's own historical performance, ignoring all other assets. In contrast, cross-sectional momentum ranks all assets in a given universe at the same time. It buys the top decile, the best performers, and shorts the bottom decile, the worst performers. This signal is relative, comparing each asset to its peers. This distinction is not cosmetic, it leads to entirely different risk and return profiles. TSMOM can be net long or short depending on market trends, while XSMOM is inherently market neutral, isolating relative strength. The time series momentum signal is elegantly simple. For each asset I, we compute the sign of its cumulative return over the past J months, typically 12 months, skipping the most recent month to avoid short-term reversal. If the sign is positive, we go long; if negative, we go short. This signal captures the asset's own trend, independent of other assets. The underlying mechanism is positive autocorrelation. Past returns predict future returns in the same direction. This occurs because investors tend to underreact to new information, gradually adjusting their valuations over time. For example, if a commodity has been rising due to supply constraints, the price may continue to rise as the market slowly incorporates the full impact. This momentum effect is robust across asset classes and time periods, making TSMOM a reliable source of returns in trending markets. Cross-sectional momentum uses a ranking approach. For each asset in the universe, we compute its past return over the same window, typically 12 months skipping the most recent month. Then we rank all assets from best to worst. The strategy buys the top decile, the highest past returns, and shorts the bottom decile, the lowest past returns. This creates a zero net exposure portfolio, isolating relative strength. The signal is not about direction but about relative performance. This is why XSMOM is market neutral by construction. The long and short legs offset each other, so the portfolio's beta is approximately zero. The mechanism behind XSMOM is cross-sectional underreaction. Investors have limited attention and tend to focus on a few winners, herding into recent winners and ignoring potential losers. This creates a persistent relative strength effect that XSMOM exploits. The key difference between TSMOM and XSMOM is whether the signal is absolute or relative. TSMOM compares an asset to its own past, so the signal is absolute; it only cares about the asset's own trend. XSMOM compares an asset to its peers, so the signal is relative; it only cares about how the asset performs relative to others. This distinction has profound implications for net exposure and crisis behavior. TSMOM can be net long, net short, or zero, depending on the mix of assets with positive and negative trends. This flexibility allows TSMOM to profit from both up and down markets. XSMOM, on the other hand, is always market neutral, with equal long and short exposure. This means it is less affected by broad market moves but also less able to profit from strong directional trends. The most critical engineering difference between TSMOM and XSMOM is net exposure. TSMOM can be net long, net short, or zero, because each signal is independent. During the 2008 financial crisis, TSMOM systems shorted stocks and bought bonds, generating significant positive returns. Similarly, in March 2020, TSMOM profited from the crash by shorting equities and buying safe haven assets. This is why TSMOM is called crisis alpha. It provides a hedge during market turmoil. XSMOM, however, is forced to be market neutral, long top decile, short bottom decile, so beta is approximately zero. In a crisis, when all stocks fall together, XSMOM can only capture the small difference between strong and weak stocks, often performing poorly. For example, in 2008, XSMOM suffered losses as the correlation among stocks increased, reducing the dispersion needed for relative strength to pay off. Both TSMOM and XSMOM exploit underreaction, but in different dimensions. TSMOM profits from time series underreaction. Investors anchor to historical prices and update slowly, leading to positive autocorrelation. Macro trends in inflation, growth, and policy are gradual, so prices take time to adjust. For instance, if inflation rises, commodity prices may trend upward for months as the market gradually reprices. XSMOM profits from cross-sectional underreaction. Limited attention means investors focus on a few winners, and herding pushes money into recent winners. This creates a persistent relative strength effect. The behavioral mechanisms are distinct, leading to low correlation between the two factors. This low correlation is a key reason why combining both strategies can significantly improve a portfolio's risk-adjusted returns. The two strategies perform differently across market environments. In strong trends, both excel. In crises, TSMOM shines while XSMOM is mediocre. In choppy markets, TSMOM suffers from whipsaws, as false signals lead to frequent trading losses, while XSMOM can still extract small relative gains. In V-shaped recoveries, XSMOM leads because it quickly captures relative strength, while TSMOM lags due to lagged signals. For example, after the 2020 crash, XSMOM quickly bought the strongest tech stocks, while TSMOM was slower to switch from short to long. In high-inflation commodity supercycles, TSMOM is strong, as it captures the persistent upward trends in commodities, while XSMOM is less so because it focuses on relative performance, which may be less pronounced in a broad-based rally. AQR's long-term study shows that TSMOM has delivered an annualized Sharpe ratio of about 0.4 from 1880 to 2016, comparable to the equity premium but with low correlation to traditional assets. In equities, XSMOM has historically provided about 1% per year in excess returns, though this decays over time due to arbitrage and crowding. The correlation between the two factors is estimated at only 0.2 to 0.3, making them powerful diversifiers. For example, if TSMOM has a Sharpe of 0.4 and XSMOM has a Sharpe of 0.5, combining them with a correlation of 0.25 can result in a combined Sharpe of over 0.6, a significant improvement. This diversification benefit is why many institutional investors allocate to both strategies. In futures markets, TSMOM dominates. CTA funds, which manage over 80% of trend-following assets, rely primarily on TSMOM because futures allow easy long and short exposure across asset classes. XSMOM is used in a smaller niche called cross-sectional CTA, which trades relative value across futures contracts. In equities, XSMOM is the classic factor, as in Jagadish and Titman's 1993 paper, which showed that buying past winners and shorting past losers generates significant abnormal returns. TSMOM can be applied to equities but often in long-only form due to shorting constraints, limiting its effectiveness. In practice, equity long-short funds use XSMOM, while macro funds use TSMOM. In FX, both work well, with carry and momentum combinations common, as currencies exhibit both time series and cross-sectional momentum. The low correlation between TSMOM and XSMOM creates a powerful diversification benefit. The combined Sharpe ratio depends on the weights, volatilities, and correlation. With a correlation of about 0.25, combining the two can significantly improve risk-adjusted returns. For example, if TSMOM has a Sharpe of 0.4 and XSMOM has a Sharpe of 0.5, and they are combined with equal risk weights, the combined Sharpe can be approximately 0.65, assuming a correlation of 0.25. This is why top funds like Renaissance, 2 Sigma, and Millennium employ both strategies. They allocate capital to each based on risk parity, ensuring that each contributes equally to portfolio risk, thereby maximizing the diversification benefit. Asnis showed a deep mathematical connection. Cross-sectional momentum is essentially time series momentum demeaned across the universe. In other words, XSMOM equals TSMOM minus the average TSMOM signal. This strips out the market direction component, leaving only relative strength. This explains why TSMOM includes a market direction premium, which is why it performs better in crises when markets have extreme direction. For example, if all assets are falling, TSMOM will be short all assets, profiting from the market decline, while XSMOM will be long the least bad assets and short the worst, capturing only the relative difference. This mathematical link also implies that the two strategies are not independent but have a known relationship, which can be exploited for portfolio construction. The choice between TSMOM and XSMOM depends on your objectives. If you want crisis protection, low correlation, and positive skew, TSMOM is the answer. It can be accessed through CTA funds or multi-asset trend systems. If you want market neutrality, stable excess returns, and high capacity, XSMOM is more suitable, often implemented as a stock multi-factor or commodity cross-sectional strategy. For the best risk-adjusted returns, combine both, allocating weights via risk parity. For example, an investor with a diversified portfolio might allocate 50% to TSMOM and 50% to XSMOM, rebalancing quarterly to maintain equal risk contributions. This approach captures the crisis alpha of TSMOM and the stable relative value of XSMOM, resulting in a smoother equity curve. Time series and cross-sectional momentum are not two flavors of the same strategy, they are distinct risk premia with different construction, exposure, and return drivers. TSMOM asks whether an asset is rising on its own, while XSMOM asks whether it is strong relative to peers. TSMOM provides crisis alpha and directional exposure, while XSMOM offers stable relative value. Their low correlation makes them powerful complements. Understanding this distinction is essential for building robust multi-strategy portfolios. Your engagement helps us create more content on quantitative finance and portfolio construction. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.